Hey guys, we're going to get started in about 2 minutes. We're just going to let a couple more attendees trickle in, and we'll get started in about 2 minutes. Hey everyone, I'd like to get started now. Thanks for coming out. Looks like we've got a great attendance tonight. The topic that I'll be speaking about tonight is investing in real estate and how it can net you 20+% returns. And I want to dive into the how and why to invest in real estate. I also have a very special guest with me tonight. His name is Christian Dye, and he's one of the very select number of few financial planners that I really enjoy working with. And the reason for that is that Christian doesn't just put all of his clients just into stocks. He also believes that a balanced look and a balanced feel in somebody's portfolio, including real estate and including stocks, etc., is really important. And he's also an Excel nerd, just like I am. He loves doing analysis and whatnot. And so we're going to talk a little bit about that. I'll introduce Christian. He's got some slides a little bit later in the presentation, and he can talk a little bit about some of the stuff that he likes to do. Some of the analysis that he does makes my spreadsheet look like a young child. So I'll be excited to bring Christian to the and he can show his slides in a little bit. So let's get started. Do you want to talk about why you should be investing in real estate? I'll be talking about leverage, the returns in real estate, and going through then the process of how to do it. Step 1, getting a home equity line of credit. Step 2, creating a game plan. Step 3, doing deal analysis. Step 4, joining communities and learning and growing. And step 5, taking action. And then I'll also go into a couple of quick tips near the end. So first of all, why invest in real estate? Well, this is a pretty good reason to invest in real estate. 90% of millionaires made their first million in real estate, which I thought was quite interesting. And when you look at it and how many millionaires exist in Vancouver, Toronto, and many other major markets around the world, there's a lot of millionaires that did so just by owning real estate. It's one of the simplest and easiest ways to build your wealth. And one of the reasons that I focused on becoming a real estate investor-focused mortgage broker for most of my career since 2008. So why invest in real estate? One of the most important things is looking at the leverage. Leverage is one of the most important aspects of investing in real estate. To put things in perspective, with most investments, you usually have to put up all the cash and put that in. Whereas investing in real estate, if you're buying a personal residence, you can do it as little as 5% down. And this includes second homes, by the way, which is a common question we get asked. If you're buying a second home for immediate family or for personal use, you can also buy that with as little as 5% down. If you're buying a rental property, however, the minimum down payment is 20%. Now, that being said, these ratios are still really good. You're only putting down, if you're buying your own personal residence, as little as 1/20th of the total property value. If you're buying a rental property, then you're putting down as little as 1/5 of the property value. So that's one of the main reasons to look at investing in real estate. And I do want to dive into leverage and the mechanics of it and the actual returns on it. So let's give you an example. If you bought a property, let's say that you bought something for $500,000, you'd be putting down $100,000. That's your 20% down. Now, if the property appreciates by 3% on that $500,000 purchase price, that means that you've made $15,000 on the appreciation. Your return on investment is not 3% if you borrowed 80% of the property. If you put only 1/5 of the property value down in cash, you've made $15,000 on your $100,000 investment. And so your return on investment from the appreciation is actually 15%. So again, if you're getting leverage, then you always use that leverage to multiply your return. So if the appreciation is 3%, but you have a 5-to-1 leverage, then your return is actually 15% when the home values go up. Here's a really cool example. Personal residence. If you buy that same $500,000 property, but this time you're putting $25,000 down and the home appreciates by 3%, so 15%, what is your return in this case? 60% return. Now, we've seen some properties in the last last decade or going back even further, there's certain periods of time, especially the last year, where home values have appreciated 30% in 1 year. Imagine that. If you bought a property, personal residence, with only 5% down, if the home value went up by 30% in 1 year, your return on investment over that 1 year would be 600%. Now, I would never, ever tell somebody you should invest in real estate, you're going to make a 600% return on your money. That's ludicrous. But at the same time, too, in short stints and short windows, home prices can appreciate at that clip. And in general, that's where you really make a lot of your money on the leverage aspect, investing in real estate. One of the main reasons that real estate is a very desirable asset class because of the amount of financing you can get. And it's not just about the leverage, however, it's also about cash flow. In many cases, if you're putting 20% down, you're buying a property that will be a strong cash flow property. You're getting about a 1 to 4% cash on cash return. Obviously, this is much more difficult in major urban centers and markets. So in Vancouver and Toronto, especially detached homes, et cetera, getting this kind of cash flow with only 20% down will be quite challenging. However, if you're going to smaller markets or suburban areas, then often that kind of cash flow is doable. Often I tell clients, especially if you're buying in or close to a major urban center, if you can put 20% down on that property and it produces no cash flow, but it's either positive or negative, then that's probably a decent deal. There's also the appreciation, which we talked about earlier, which if I assume about a 3% annual appreciation, which by the way is below the average for all of Canada for the last 30 years, is way below the average for major urban centers like Vancouver and Toronto, et cetera, over the last 30 years. But I like to use an average of about 3% per year. If you look historically and also a bit more global with this, in general, appreciation on real estate is about 1% more than the inflation of the country. And so in general, Canada's target inflation is 2%. If we use an annual appreciation of about 3%, I think that's a safe number on a moving forward basis and a number that is reasonable to use in your calculations. Now, this being said, a lot of people focus on cash flow and appreciation, but I'm going to tell you there's a really important one that people forget about, and that's the mortgage pay down. People don't think about this one. And the reality is if you bought a property and had the tenant just covering your mortgage for you, and if you had no appreciation, you'd still get about a 7.5% to 9% return on your money every year by having a tenant pay down your mortgage for you. So to put that in numbers, in that previous example we used, where the property value is $500,000 and you put $100,000 down, That means that if your tenant just covered your mortgage payments for you, they're probably paying off about $7,500 to $9,000 per year of your mortgage. And that's something that people often forget about. And this is where, if you look at many other investment asset classes, even if you just got the mortgage payment or pay down as your return on investment of about 7.5% to 9%, that's going to outpace a lot of other investment opportunities, especially investing in mutual funds with your bank, or worse, please don't talk about GICs around me. So these are the three primary ways that you make money in real estate. Of course, if you put extra effort and equity into a property and renovate it, et cetera, then you can increase the value even further from there. But in general, if you just buy your rent and like a buy and hold and just hold it, this is where you're making your money. Now, here's what's crazy. You add this all up, it's like, holy cow, it's 24 to 27% return on my money. That seems so high. I mean, if you told somebody, hey, I have an opportunity for you, the return is 24 to 27%, most people would say, oh, that must be risky. When you break this down, though, with purchasing real estate, I don't think that 3% annual appreciation on average over a long period of time is that crazy of a number. The mortgage paydown isn't that crazy of a number. If interest rates really skyrocket, then yes, you're going to have a little bit less in the mortgage paydown, but it's unlikely to change a lot. And so when you look at these figures, it's hard to refute and hard to argue that purchasing real estate is a really, really good asset class and something that people should have as part. It doesn't need to be all, but at least part of your total retirement strategy. So how is the return on investment broken down? It's broken down by cash flow, mortgage paydown, and appreciation. And I wanted to show a chart of where the total ROI is coming from. So only out of that 24 to 27%, only about just under 10% of that total return is from the cash flow perspective. But I don't want to make this seem like cash flow is not important. Cash flow is very important because you need cash flow to make sure you can service the debt on the mortgage that you're getting on the property to get that leverage. So the cash flow is a very important piece of the puzzle. In addition to that, if you have negative cash flow and eventually you have to be forced to sell a property because it's negative cash flow in an inopportune time, in a bad market or bad climate, that may result in you actually losing money on your investment. I feel like if you're able to hold real estate for the long term, there will be a good opportunity to sell that property and make money. And that's why the cash flow is really important, to give you that length of time you need to hold on to it, to realize that appreciation, because appreciation often doesn't come at a nice steady clip where it goes up by 3% every single year. Appreciation often comes where it's flat, and then boom, it goes up by 10% one year, and then it's flat again, goes up by 30%. There often are big bumps up or down, of course, in real estate. So this is where having cash flow gives you that longevity to hold it for a long period of time. Looking at the chart here now, mortgage paydown is about a third of your overall return on your investment, which means that the remaining 58% of that total, 24 to 27% return, is actually coming from the appreciation factor. So we can see that the leverage aspect is super, super important when looking at purchasing real estate, and that's why leveraging yourself and obtaining mortgage debt safely, and I usually like to use the term use but don't abuse leverage when building a real estate portfolio. It's important to see that, okay, yeah, a lot of my return is coming from the appreciation factor, and that only comes if you're getting a lot of leverage. If you bought the property purely with cash, then your return from the appreciation would be significantly lower. So looking at that, who's in, who's excited, who wants to get going and invest in real estate? I see a lot of virtual hands here. I really wish I could do this in person, by the way, but such is life. This is COVID life. We're resorting to having to do webinars now, and that's just the way it is. Okay, I see a woohoo from one person. Awesome, thank you guys. I can see you guys are really excited behind the screen. So you guys want to make some money or what? So why don't more people invest in real estate? Well, it is a little complicated and it's a little daunting, isn't it? If you want to invest in stocks, you can just sit down and say, hey, bank, what do I do with this money that I have? Can I put up $500 a month just into an account, and how do I build it and grow it? Buying real estate is a bit more daunting. It seems a lot bigger of a task. And so because of the complications, it holds people back. The other factor is getting a mortgage. Getting a mortgage is not a lot of fun. Some people do not qualify for mortgages. I usually tell people that getting the mortgage is not the fun part. It's usually the part that you have to. It is the means to the end in order to achieve your goals and dreams of becoming wealthy or retiring early or whatever your life goals are. Getting a mortgage has become a lot more challenging or difficult. The amount of paperwork that you need now has probably gone up by between 2 to 4 times, depending on your profile, depending on the situation that you're in. I mean, we looked at files from 10 or 15 years ago, and the amount of documentation that we needed then versus what we need now has changed drastically. That being said, I still like to try and drill this down and make it easy and go step by step on how do you become a real estate investor? How do you get involved in this? And what's the first step? What's the second step? How do you start to grow your real estate portfolio and eventually build some wealth for yourself in a nice, simple, easy way? So the first step, you need to get capital. You need to access capital. You need to figure out where that is. And no, the piggy bank probably does not have enough cash in it. I'm sorry to say. Your kids will be thrilled though that you're not going in there and smashing that piggy bank into bits and telling them that you're going to buy real estate with it. But your property probably has a lot of equity and a lot of coins in it. And so getting a Heloc or home equity line of credit against your residence is often step number one. Let's give you an example here. Let's say that you owned a property worth $500,000 and you currently have a $225,000 mortgage on it. What you could do is you could access up to 80% of the property value. So in this case, you could get a line of credit for up to $175,000 against that property. And that $175,000 is then used to invest. So this product that you're looking at here is called a Heloc or home equity line of credit. And it allows you to use your home as an investing ATM machine, essentially. And so what happens over time is you're going to slowly pay down your mortgage on your principal mortgage, the $225,000 portion. And as you do that, the line of credit limit will slowly increase. And over time, what you're doing then is you're borrowing this money against the line of credit to invest. Now, what's even cooler about this is that the money that you borrow to invest is also tax deductible. So yes, you get to write off the interest portion of your payments for your invest with the intention of earning an income. And so this is a really cool strategy and a really cool tool. This is actually the topic of my last month's webinar because it's that important. And yes, taxes can be very, very boring. I get it. But doing this simple maneuver is a way of you being able to not have to choose whether you're going to pay down your mortgage or you're going to invest. It actually makes this decision very simple because all you have to do is pay down your mortgage, which then will open up more room on your line of credit. And then you have that capital available to invest. And even better, you get to write off the interest portion of the payments that you've now borrowed to invest. And so over time, what happens is you can slowly convert your mortgage from not being tax deductible to being fully tax deductible. And if you'd like to learn more about this, a friend of mine, Robinson Smith, wrote a book. His father actually wrote the original book called The Smith Maneuver, and Robinson actually wrote the follow-up book to this to go into some more details and really drill down into it and just update it a little bit for the current climate. It's a great book and a great read. A lot of information inside of there, and so if you wanted to dive into it and learn more. I actually do have a couple of extra copies at our office. I believe we still have some copies at the office. So if you did want a copy of that, you can email us at info@greenmortgage.ca. And if you have some extra copies of the book, we'll be happy to send it over to you if you'd like to learn more about the Smith Maneuver. So step number 2, you've accessed capital. Now you need to start to plan. And no, the year's not 2018. I guess I should have changed that before I figured out the slides. It's one of those things, you always go through your slides and you're like, oh yeah, everything's updated, everything's good. And I'm looking like, it's not 2018 anymore, Kyle. It is 2022. Yes, time flies. So making a plan, it's all about how you're going to grow your real estate portfolio and build it. How many properties do you want to have? And the reality is, a plan for somebody who wants to buy one rental property is very different than somebody who wants to buy 20 rental properties in the next 10 years or 5 years, okay? And the reason that this is different is there's different corporate structuring. So should you be incorporating or not? The mortgage structuring should be considered here too. There are certain lenders that won't lend to you if you have more than 5 properties or 10 properties. Some lenders that will, and guess what? Of course, there's less lenders available to you as you grow your portfolio. And in some cases, that planning of which lenders to use for your first few rental properties and which lenders to use for your last rental properties, that's really important and relevant here. Other things like, should I incorporate or not? And it's very difficult to redo and unwind your current structure. And I find a lot of our clients that buy a few properties in a personal name to start, and then they realize, oh my gosh, I should have bought in a company name, and now it's very difficult and expensive to redo that. And so it's very important to have a clear idea and a clear plan in mind. And with that clear plan that you communicate well, it helps with your mortgage agent to help with the planning and figure out, okay, based on what you want, here's what I would recommend. This is how we can grow your portfolio and build it. Now, the plan also comes down to where are you at with things. And this is kind of the natural progression for a lot of our investors, is usually start off with your residence, and then maybe you buy your first rental, or sometimes we find that some people will buy a residence and then they'll buy a new residence for themselves when they'll take their current residence and turn it into a rental property. That's a very common thing that we see. It's one of the easiest ways of growing a real estate portfolio, to be frank, is just to keep everything that you buy. Your very first property, if you're buying a primary residence for yourself, buy something that would be a good rental property with 5% down. And then eventually, when you're ready to buy a new residence for yourself, keep this in mind, you do not need to be a first-time home buyer to buy with as little as 5% down, which is really cool. So if you buy another residence for yourself, you can buy that one with as little as 5% down again, as long as you have enough income and you qualify. And so you can effectively buy all these properties that eventually become rental properties, but you only put 5% down on them. You didn't have to put 20% down. Now, there's also getting up to the 5 rental property stage, and that's a different plan altogether. A lot of people that we work with have, 1 or 2 rental properties, and that's about it. Sometimes it's just, people got married and got together, and each of them had 1 residence, and then they kept both of them and bought a residence together, and now they have 2 rentals combined. But when you get up to 5 rental properties, you're starting to become more of a business owner, and things get a bit more complicated. And frankly, at 5 properties is where a lot of the lenders draw the line in the sand too, and say, hey, if you own more than 5, you're a commercial client or a small business client. And all of a sudden, they're pushing you over to more expensive lending. You need to put more down payment down, and the lending guidelines completely change. I've done webinars about commercial lending versus residential lending and how they differ. And so if you wanted to learn more about that, you can always visit our website to see and learn what the difference between the two is and what commercial lending is. But commercial lending often is if you have too many residential properties, then they push you into small business or commercial. Also, if you're buying a property that is 5 units or more on one title. So if you're buying a 10-unit building, then that would definitely be a commercial loan, and the guidelines and qualifications are completely different for that. So how do you qualify for mortgages? This is how lenders look at it. A lot of lenders use something called the 50% add to income method. Let me give you an example. If you had a property with $1,000 a month in rent, they would take $500, so just 50%, and they would add that to your income. And then in general, they use about 40% of your income towards all of your debts. And so if they take 50% of $1,000, so $500, add that to your income, and then use 40% of the $500, they're only using $200 a month out of that $1,000 a month in rent. A 50% add to income method is really, really tough. And in general, that means that every rental property you own, if you're working with a lender that uses this method, every rental will be a negative on your application. It's very difficult to build a portfolio with lenders that use this type of qualification method. Next is what's called an offset, and many lenders are about an 80% offset, give or take. An offset is different. So in this case, what they do is they take 80% of that $1,000, so $800, and they write off all the expenses against it first. And so if the expenses are exactly $800 a month, then there's no net effect of having that rental property on the books. If there is a shortfall and there's let's say the expenses are $900 a month, then they would just take the $100 shortfall and add that in as a liability. So it doesn't make a huge impact on your debt servicing. So effectively, at the end of the day, out of the $1,000 a month, $800 is used. What a difference that is. In the 50% add to income, only $200 is used. 80% offset, they're using 4 times the amount of rental income. You can imagine as your real estate portfolio starts to grow, if each of those rental properties is a loss, according to the lender, it pulls down your borrowing power significantly and makes it harder and harder to qualify. And so we find that as your portfolio grows and gets larger, we rely more and more on lenders that use high percentages of the rental income to qualify you. There's another method as well that some lenders use, like TD and CIBC, and they use what's called the DCR, it stands for debt coverage ratio. And what they want to see is that the portfolio and the property that you're financing is covering itself on a 1.1 or 1.2 ratio of income to debt. So that means that if the property is generating $1,100 a month in rent, then they would want to make sure that the expenses, including the mortgage, on the stress test, by the way, and all the other expenses like property taxes, strata fees, heat, etc., those expenses don't exceed $1,000 a month. And so that would be a ratio of 1.1 to 1, $1,100 in rent to $1,000 a month in expenses. This means that with lenders that use a DCR, they reverse engineer the maximum loan amount you can obtain. And it can make it much more challenging, especially when the stress test came out back in 2016. It made it a lot more difficult for clients to qualify for large amounts of financing with lenders that use this debt coverage ratio, unless they're buying in a market where the rents are very, very high. For instance, we had a client recently that had a large portfolio and was buying a couple of rental properties, and the bank would only give him 35% financing. So he had to put 65% down payment in order to do it, to fit the debt coverage ratio guidelines and qualifications. So in general, the DCR is actually how lenders treat commercial lending as well. And so usually on the commercial side, they do the same thing. They reverse engineer how much you qualify for based off of the income and assets of the property, except they're usually looking for something closer to about a 1.25 income to debt ratio. So step 3 is doing deal analysis. And this is really important to be able to figure out, okay, how strong is this deal? Should I buy property A or should I buy property B? I do have some tips and hints on how to do deal analysis, and I know Christian's going to jump in a few minutes here too, and I'll talk about how he does deal analysis, because he's got a completely different, well, not completely different, but he has a different way of looking at it and evaluating it, and he likes to dive really deep into the numbers and stats, which I really appreciate about him. So on the deal analysis part, the first thing I always look at is I just do a very quick rent to price ratio. Okay, so that means that if I'm buying a property or looking at a property that is priced at $500,000, for instance, right away I know that if the rents are about $2,000 a month, so if the monthly rent is 0.4% of the purchase price, then I know that the property will probably be about break even on my cash flow. That's just a really quick number that I calculate. Because ultimately, at the end of the day, your deal analysis is just a matter of taking a lot of information at the top end and just funneling it down in an efficient way. If I look at that rent to price ratio, anybody can tell me a number really quickly and say, "Hey, Kyle, I found a $1.2 million property that rents out for $6,000 a month." I'm like, "Wow, that's a 0.5 rent ratio. That's quite good." I know that probably will cash flow better than another client who might say, "Hey, Kyle, I found a condo for $300,000." The rent's for $900 a month. I'm like, oh, that's only a 0.27 ratio. That won't be cash flowing as well as the more expensive property. And that's an important note, is that sometimes the more expensive properties, even though it seems more prohibitive to get into that, sometimes you're better off to bring in a partner or two and go with the more expensive deal if it produces more cash flow. It's actually what I did on my very first joint venture deal that I did back when I think it was 2011 or 2010. 2010. I did my first JV deal with zero down. I brought in a partner to do it, and initially I had my realtor looking at properties for $300,000 or $400,000 because that was the price range I thought that was affordable. And he sends me a deal for $1.4 million. I'm like, oh man, I'm 20 years old now. You think I made money? Like, come on. But I ran through the numbers, and I had created a spreadsheet for myself, which I'm going to talk about in a little bit. But I ran the numbers in my spreadsheet, and I realized that, oh my gosh, this place actually cash flows much better than other deals do. And so I looked at the figures and numbers and realized, oh my gosh, this deal is much better than anything else that I could find. The rents on it, because it was a fourplex with an additional carriage home, the gross rents were $7,600 a month. And I negotiated the price down to $1.15 million. So you can work up the numbers, but it's a very good rent to price ratio. It was over 0.6% rent to price ratio, which means that it was cash flowing very, very well. And it actually made it easier to find a bigger deal and better cash flows. It was easier to find an investor to go in with me on that one than it would have been for the smaller deals, because I was dealing with different people that had bigger players, more cash, and were looking for bigger cash flows and bigger opportunities. Now, the shortcut I like to use is that in general, every $100,000 you borrow is going to cost you about $400 a month. Okay, so every 100 grand you borrow is about $400 a month. So if you're doing quick math on, okay, well, if I borrow an extra 100 grand, or if I do this or do that, or if I buy a property that's a bit more expensive, I can expect that my payments to be about $400 more per month. a good example of this, and looking at this, is if you're looking at a home for yourself that you want to live in, and you're trying to compare a home that has a suite in it versus another home that does not have a suite in it. If the home that has a suite in it is $100,000 more, well, that would probably cost you about $400 more per month to buy and borrow all of that extra purchase value. And so an extra $400 a month in your mortgage would be offset, however, by a basement suite that would rent for maybe $1,200 or $1,400 a month. So you're actually better off net per month buying the more expensive home that has a basement suite in it, because of that increase to the rent. Even though the mortgage has gone up, it hasn't gone up by the same amount that you're now getting in rent. So it's an important thing to just keep that in mind when you're doing quick analysis. Using tools, I have a couple of tools that I use. I have a cash flow analysis spreadsheet that I built, which is available on our website that you can download. Our website is www.greenmortgageteam.ca. So you can download that cash flow analysis spreadsheet. It's a very quick and easy to use tool. Just to run some numbers and it'll tell you what your monthly cash flow is and your return on investment, et cetera. But having something where you can quickly punch in numbers and then just assess it very quickly, I found to be very valuable. So the first thing I always look at is rent to price ratio. And then if that passes, then I start to go into a more in-depth analysis. The other thing that I like to use is a website called rentometer.com or Craigslist. In general, I find that Craigslist is a little bit too much work for me, I find, to actually dive in and figure out what the rents are in the market. If you have a very unique property, then you might need to see if there's some comparable places for rent on Craigslist that give you a better understanding of what the market looks like. But Rentometer gives you nice macro data. So you can punch in the number of bedrooms and the location, and it'll give you the 25th, 50th, and 75th percentile for what the rents are in that market. So if I'm buying like a brand new condo, I would probably put myself in the 75th percentile because I feel like my property will be nicer than the majority of the marketplace. If I'm buying a really old property that I don't plan on renovating, then I might put myself in maybe the 25th percentile for the rents in that marketplace. So Rentometer is a really useful tool that I find helps me quite a bit. Another thing that I look at too is I like to quickly filter and use specific metrics to compare the return on investment. And so looking at different keys, different components, and quickly gaining an understanding of a specific market. Certain markets you're going to find different properties perform better in certain markets. For instance, in Vancouver, it'd be very, very difficult for you to find a detached home that will cash flow positive. Whereas if you buy condos and maybe you fully furnish it and then rent it out to medium-term customers where they're renting it for a minimum of 30 days, which is the minimum, for instance, in Vancouver, that might be a little area where you might be able to make more money, and the return on investment might be stronger in that type of deal than maybe buying a detached home. But you're always wanting to use different metrics to compare your return on investment and just gain a really good understanding of like what works in certain markets. Because detached properties in Prince George, for instance, would probably outperform condos in that market. And so you're going to see that there's little flip-flops. And I see a question about Rentometer being only in the US. If you type in a Canadian address, it will work. I do have the premium account and whatnot, but I still think that it will work for you if you just type in the address. It looks like it's US based, but if you type the full address, it will pull up data for you. So this is just a snapshot of what the cash flow analysis spreadsheet looks like if you wanted to download a copy of that. Step 4, getting connected. It's really important to get connected into the investor community. There's a ton of investment groups out there that you can join. There's lots of meetups. Obviously, with COVID, there's a lot less in-person events happening right now, so a lot of these are going virtual. A little less in-person networking than we're accustomed to, and trust me, I used to go to pretty much all of those. But of course now it's getting a little bit tighter, and there are less options out there. But we're going to find that as COVID relaxes, a lot of these people will be more than happy to meet in person again. You're going to find a lot of the meetups and large investment groups will be doing things in person again. And these are great opportunities to network with other people, watch different people present and speak, and for you to learn from other people that have been there and done that, but also just observe and network to maybe find a joint venture partner or somebody that you might be able to do business with in the future. There's been a lot of aha moments for me watching other people speak on stage or just networking and connecting and having one-on-one conversations with other people. Step 5, which is my last step, is you got to take action, guys. If you sit here on your tail, just watching your tail go back and forth and back and forth, and do the analysis paralysis thing, which I know a lot of you have. It's really important to just get out there and just do something. Try it. Write an offer on something. Lowball something. It doesn't matter, but get yourself out there. Push yourself into a situation where you're starting to take action. And what you're going to find is that you're going to turn your knowledge that you've been gaining into action. It's really important that you just jump into it, and sometimes head first. But make sure that you have good people around you that can protect you and give you really good advice and input to make sure that you're not completely overwhelming yourself. But ultimately, all of this knowledge does almost nothing for you if you don't actually take action and do something with it. So at this moment, I'd actually like to bring Christian to the forefront here and give him a few moments to speak, because Christian has another viewpoint and whatnot, especially with being a financial planner and building his book of business with clients that are both real estate investors and stock investors and other types of investors. So, Christian, if you'd like, you should be able to share your screen now, and then you can go into through some of your slides.
All right, Kyle. Can you hear me?
Yep, can hear you.
Okay, so give me 1 second. So I think, do you need to stop your screen share there?
It should allow you to share while I'm sharing.
Okay.
At least I've authorized that, but if it gives you an error, then let me know. There you go.
Can you see my screen okay?
There it is. Yep.
All right. Okay, let's see how far we get over here. I'm trying to do the panel screen here. All right, technical glitches.
That's okay.
How's that?
There we go. Yeah, you got it.
Okay. So I'm going to fly through this fairly quickly because I want to leave time for questions. I have a team here in Vancouver, but we are licensed across Canada over here. And my team is unique because kind of what Kyle has said over here, we like real estate. Our business model is a little bit different from traditional financial planners. We do the traditional things: investments, RSPs, TFSA. So we're not saying to not do that. We're not, and then we could also help with financial planning as well as insurance. But I think the part that makes us really unique is the real estate part. That really is the real estate part, because we have so many clients who come to us who say, oh, you know, I went to the bank or I went to my traditional advisor and I was telling them that I want to free up, $200,000-$300,000 to invest in real estate out of my stock portfolio. And then they sort of seem to get the same reasons why not to do it. And then 3 or 4 years later, they realize that, this was a huge mistake. The property values that they were thinking of investing have gone up quite significantly as compared to what their investments have done. So we kind of practice what we preach. I myself invest a lot in real estate. So how could I tell my clients to not consider it? But then, of course, they had a lack of knowledge, and that, of course, is where we come in. So Kyle kind of teed me up a little bit and said, I'm good at comparing what your typical portfolio would do compared to what it might look like if you were to invest a portion of your income in real estate. So, here's a really, really basic split. 80% bonds, 80% stocks, 20% bonds. This is somebody who's sitting on $150,000 of cash, for example. Our philosophy we would probably look as a comparison to say, we like stocks, we don't love them. We love real estate, but we also want to make sure your money is protected. So we want to make sure there's some form of a reserve as well. So we like to chop it up a little bit different. And one of the reasons why this formula works a little bit better is because it keeps the volatility significantly lower. You got to remember, if you had a 100% stock portfolio, if you go by the standard deviation of the last 100 years, you're looking at 15, 16%. Okay. So one of the reasons why we bought into this model is because it's what some of the wealthiest investors in the world are doing. And if anyone's not familiar with the Tiger 21, you might want to just YouTube this group really quickly. To be part of this group, you need a minimum of $10 million minimum just to join the group. And the average investor has about 100 million. These are very, very, very wealthy individuals, but they're not giving their money to someone. That's not what the Tiger 21 is. It's just a group of collaboration. They have guest speakers. They talk about what each other is doing. But because this is such a unique group, and they have chapters all over the world, they dissected to say, what are the richest investors in the world investing in? I'll summarize really, really quickly. Is it 100% stocks? And the answer is no. If you take a look at the portfolio that I put in front of you over here, less than 50% of it is subjected to purely the stock market. 31% of this is in the real estate market. Not only that, you have almost 22% in a very, very low yielding, very accessible funds, either fixed income or cash itself. Very similar to the allocations that we've done. Why isn't it so important to have this reserve fund? Isn't that money not making much? The answer is yes, but it's waiting to pounce on the next opportunity. And the next opportunity could be in the stock market, like it was in COVID, or it could be in the real estate market. But if you don't have cash or access to it, how can you really, really pounce on the next opportunity? So we want the stocks, but we want the real estate because of what Kyle said, the leverage. It's a long-term play. That leverage is an accelerator. You put in 100,000 on a $500,000 place, and it goes up by 10%, your cash has actually gone up fivefold, fourfold, or fivefold. So what we should be doing is modeling some of the wealthiest investors in the world, such as the Tiger 21. So if we take a look at this over here, it gives us a quick snapshot of what is the returns of stocks and bonds. Okay, so here, if we take a look at the S&P TSX Composite, just for the last 10 years, mix the two together, 6.7% annual return. If we go since 1985, that's an 8.5%. That's not why I'm showing this. I'm showing this for the standard deviation. Look at the volatility, 15.5%. Then we move to bonds over here. Last 10 years, 4.3%, but this is just on the Canadian Universe Bond Index. Right now, we're getting reports this year that the bond yields are less than 2%. Look at the standard deviation, 6.1%. 5-year GICs, which I know Kyle doesn't like, even lower. And consumer price index is around at least 2%. But right now, inflation is looking at close to 4% in these years right now. So now Kyle has said, what is the ROI on real estate? His formulas are a little bit different than mine, but the concepts are definitely the same. This is what I would look at. You can't just look at the growth of the real estate. You have to look at the ROI on what your down payment is, your actual investment. So let's say we have a $50,000 investment for a $250,000 property. Mind you, this will be very challenging to get in the Lower Mainland, but not challenging to get when you go across Canada. Let's say that this particular property cash flows break even on year one, which is what I really like. I don't like negative cash flow. I like cash flow positive or break even. Okay, so in 10 years later, rent goes up, mortgage goes down. Just as an approximate, you're now $300 a month, cash flow positive year 10. Okay, 20 years later, mortgage is almost gone. 1,000 a month of cash flow positive year 20. And then year 30 and above, okay, this thing is fully paid off, whatever the rent is, minus property taxes, minus strata fees. So now we're going 3,000 per month. I've increased the rental rates also by the average that rent increases. So I used about a 3%. What did I use on the growth of the real estate? A nice conservative 5%, not even Vancouver numbers, nice conservative 5%. Capitalization rate, about 4.3. So here, what is the future value of this property off of a 5%? In 5 years from now, this property should be worth about $319,000 based off of my 5%. But in 30 years from now, it should be worth about 1.1 million. So how do I determine long-term ROI for my clients who want to know, well, what is the value of this when I retire over here? I take my $50,000 investment, I figure out the ROI, future value is 1.1 million, the place is completely paid off. What am I looking as an annual ROI, 23.4%, very similar to Kyle's numbers. He said 20 plus. And this is on a piece of real estate that is conservatively growing at 5%. Just recently, I did a review with a client. A client came to us about 3 years ago, wanted to invest in a place, had about a little over $50,000 to invest, because we were looking at several hundreds of thousands of dollars of investable assets into the stock market. But we said, we want you to diversify into real estate, which was not on her radar at all. She didn't come to us for real estate. She came to us just as financial advisors. We said, we feel there's opportunities in the market. 3 years ago, she says, yeah, but everything in BC is way too expensive. It's a terrible time to get in the market. We said, absolutely not. What you have to do is you have to be more selective. You need the right team finding the real estate for you. Make a long story short, we found a $250,000 two-bedroom condo in the Fraser Valley. That condo today is estimated at around $380,000 for a two-bedroom condo. The rent on day one was $1,200 a month. Today, $1,600 a month. When we did the review with her, we said, you know, those conservative investments that we got for you in the stock market, they've made the conservative stuff made about 5%. The more aggressive stuff made about 9%. Your real estate made 48% ROI annually. And so I don't want to promise a client that. Absolutely, I would not want to promise a client something like that. But I would absolutely show the slide I'm showing right now on the 23.4 over 30 year. So when I look at this, what's the type of ROI that we're looking at? We take a look at a traditional investment over here, $150,000. And then when I break this thing up into that 80-20 portfolio of stocks and bonds, what am I looking at? If I get an ROI of 8.24% on stocks, bonds will be much lower at 2%. This is what I'm looking at as an average, about a 7%, but look at the standard deviation, 13.34. Now, when I come in with my suggestion of stocks mixed with the bonds, mixed with the real estate, and I fast forward this, I'm getting about a 12% ROI with only a 5.5% standard deviation. The part I want to highlight is the standard deviation. I'm actually not taking a lot of risk, but I'm getting a significantly better rate of return. If right now you in the stock market, you go to your investment advisor and said, I'm aiming for a 12% rate of return, he's going to talk about volatility. He's going to talk about the downside risks, right? And he's probably going to advise you not to go that aggressive. So here, the types of analysis that I do is I will compare this, because I will never tell a client what to do. I will just show them what my analysis is showing. RRSP comparison, I will do some fancy things like a Monte Carlo analysis. A Monte Carlo analysis is when I could do a simulation, 1,000 simulations as to what the stock market is returning, what the bond market's returning, what the interest rate sensitivity is going to be on your mortgage, on what the interest rates, on what the sensitivity of growth is going to be, and I could break it down into percentages. And I could say, with the strategy that we're having right now, we have a 35% or greater chance that you will make more than $4.2 million in retirement. And I could compare this against the RRSPs. I can compare this against doing the real estate or not doing the real estate. I could compare this against a Vancouver property. I'm going to buy a Vancouver property townhouse for $1 million at $300,000, but I could compare this against other properties and say, this is where you're going to be by doing this Vancouver property. This is where you're going to be if you just did RRSPs. If we just looked at the RRSPs. Now, when people say, well, why don't I just do this myself? I don't really need you, Christian. You know, I don't need your expertise, because I know I can easily get a two-bedroom condo in Vancouver or a house out in Maple Ridge or wherever it happens to be. But a lot of times people don't understand the analysis. They don't understand how to do the capitalization rate. They actually need an advisor even more in a very, very expensive economy that we're in right now. So what I look at is I also look at cap rate, and this one over here is about a 1.64. To refresh everyone's memory, cap rate is when you take net operating income and you divide it by purchase price. I would say a cap rate is best number to what is a good cap rate over here? The question isn't what is a good cap rate, what is the best cap rate at the moment? If the best cap rate at the moment is a 1.64, then that's a good cap rate. But if you could find a 5% or an 8%, then of course you're doing better on cap rate. So I look at cap rate and then I look at cash flow. This particular property over here, unfortunately, is going to be about a negative $1,800 a month in cash flow. Exactly what Kyle was saying. Good luck trying to get a Vancouver property to cash flow. You might be able to buy it, you might have the down payment, and it might appreciate at that wonderful 8 to 12%. But your cash flow is what is going to be the big challenge over here. But let's say you had an advisor who actually encouraged real estate and actually assisted in helping you find real estate. Now let's say that this person has an alternative property that they can help you find. And let's say they could find this property and have a significantly better cap rate. This particular property was in Alberta. It was about $500,000, generated about $27,600 per year in net operating income. 5.52% cap rate. Take a look at the cash flow. This one's $600 a month. This one's $600 a month. Now, if you said you could do this on your own, then 100% you don't need me. Right? But if you said, well, I'm not sure if I could do that on my own. I'm not sure where these properties are over here. And multi-unit, we love multi-units. Remember, when you go outside of BC, outside of the Lower Mainland, things actually get quite a bit less expensive. Here was a multi-unit we helped a client get. I won't disclose the area. It was a fourplex for $780 over here. We're taking a look at the ROI year over year. We're taking a look at the cash flow. These are all the pieces you want your financial advisor helping you to do. And then we could wrap it up nicely and said, hey, if you do the RSPs, there's a 50% chance you're going to be 5.4 million plus at retirement. Or if you do the alternative, some alternative piece of real estate that you've shown us, 6.3 million, or if you do the Vancouver stuff at 6.9. This is just an example. This is just an example, and then we'll always let our clients choose. We'll highlight the pros and cons, but we'll do all the analysis for them over here. Now, the analysis that we do, again, very, very in depth. We're big on Excel. We like to show our clients what they can expect. We like to show them the risk. Kind of like what Kyle said, it's not perfect. It's not handing over money and then you're not involved. It's renters, it's property managers, it's plugged up toilets, it's collapsed roofs, it's insurance premiums going up on you. But I'll tell you now, having done this myself, invested very, very heavily for the last 20 years, it's worth it. It's absolutely worth it. And if you can't handle a lot of the hands-on, that's what property management is for. And if you said, well, I don't know where these property managers are, especially out of province, that's what a team is for. That's what an advisor is for. Every single one of my clients who I help to investigate real estate and purchase real estate, even though I'm not a realtor, but what I do is I usually have a property management referral. I usually have, different referral partners, such as Kyle and his team on the mortgage side, such as other realtors, whether they be in Alberta or Ontario or in New Brunswick. And then, for retirement, people want to know, well, if I do your strategy, Christian, where am I going to land in retirement? I will graphically show you where you will land. I will show you, and they'll say, should I do 2 properties, Christian, or does it make sense to do 3? I will show you. Does it make sense to do 2? Does it make sense to do 3? Does it make sense to do 10? It's too hard for you to figure this stuff out on your own, which is why you need the right team. So here, your retirement, it's such a great vehicle, real estate, because we have time on our hands. And what did I say about time? 30 years later, I don't know where a stock is going to be next year or in 5 years or in 10 years or even in 30 years. I don't know where real estate is going to be in 1 year or 5 years, but I do know where it's going to be in 30 years. It's going to be fully paid off for sure. And it will be a positive appreciation for sure. You now have rental income for sure, right? Those are all guarantees. I can't guarantee a stock is still going to be giving a dividend, but I can guarantee a rental property is still going to be giving a rent per month over here. Okay. So a lot of you guys over there are do-it-yourselfers, he says, well, I'm a do-it-yourselfer. I actually don't use any sort of advisor over here. And this is the reason why. And I agree with the argument over here. If I put 30 grand per year into the simple S&P 500, right? No fee advisor, in 30 years, you're going to have $3.4 million. Now, if you did use an advisor, let's say they charge you 1.5 in fees or MER, you got the same return at 8%. This is the result, 2.5. In other words, you just paid that advisor $807,000 to do something that possibly you could have done by yourself, right? That's the argument for do it yourself on fees. And I'm not arguing that. That's why I'm a fee for service. I will do a fee for service. And if you do invest with me, my MERs are more competitive than the average financial advisor out there. And if you do a fee for service different advisor, the majority of them do not encourage real estate, and my fees are actually lower than theirs when I compared. So maybe we just need the right advisor. You need the right advisor, because what are some do-it-yourself investing hidden problems over here? Well, if we do that S&P 500 and we start investing it and we start doing really well, we might try to create a trust, for our children, or we might try to put it in a holding corporation with our real estate, But now we start to realize, okay, I didn't use an advisor. I wasn't that strong on the taxation. Yes, I made this $3.4 million, but there's all these hidden fees. The state probate tax. Did you know that foreign taxation is the highest compared to compared to Canadian taxation, 51.1%? Corporate taxation and how to get the money out. Like, these are all things that can be reduced or even eliminated with the right advisor over here. People don't realize how expensive the taxation is. You might be able to grow the money, but can you free up the money in a tax efficient manner over here? We have a lot of strategic tools that we're able to introduce and that we are licensed to provide, which you can't even provide yourself because you're not licensed. Okay. Should I be using advisor? The question is maybe. Do you believe that somebody could add the value that you need? Manulife did a study where they said people who did not use an investment advisor and people who did use one, they found over 15 years, you were almost 3 times better off using an advisor. Now, I'm not saying you should pay those high fees or anything like that. And I would argue that my number is going to be higher than that 3 times if I introduce real estate into the equation over here. For those of you who are incorporated, a quick little plug for me. On February 8th, I am giving a webinar specifically for people who are incorporated, talking about taxation for stocks, taxation for real estate when it's inside of a corporation specifically, and how to have better alternatives for this. If you wanted to register for this, you could email my assistant at info@latitude-west.ca. And if you register, and you don't attend, we're going to send you the recorded link. Or you could go directly to my website at latitude-west.ca/workshops. It's on there right now under February 8th. So if you want to attend, great. I'd love to see you there. So to sort of wrap this up a little bit over here, my team is a team of financial advisors, but we like real estate. We're fee for service. We do a process of a discovery meeting, and our discovery meetings are all complimentary. If you would like just a complimentary discovery meeting just to talk about your situation, I'll either do one of 2 things. Number 1, I'll give you as much free information as I can when we talk, and you can go off and do it on your own. Or number 2, I'll explain clearly what me and my team could do for you, and then you could choose if you want to take us on, either for a fee for service or if we want to integrate all of your other investments. So if you have any questions for me and you want to set up a time to talk, I'm happy to speak with you. All you got to do is connect with my assistant, info@latitude-west.ca. and they'll find a time for you. We're pretty busy these days, but I guarantee we'll be able to set up a quick little discovery meeting for you and I over here, okay? So Kyle, with that, I hope you and your people got some great value. I really liked what you were doing with your ratio. Just recently, as in this week, about two months ago, we helped a client to purchase a property, which she had no clue out of province how to invest in. And when you gave me your little formula over there, of your 0.4% when you went rent to price, I decided to do one on my own for her. We were able to get her a 0.9%. So I really like that you shared that, because I wanted to do that. The other thing I wanted to mention is I'm going to have to echo exactly what Kyle said. For some of you out there over here, you're stuck in analysis paralysis. That's exactly where you're stuck in. And that's not a good place to be in. I have had clients where I had to beg and plead them that they should be investing in real estate, and they stayed on the fence too long. And they said, let me think about it. Let me think about it. 6 months went by, says, definitely a bad time for real estate now because it's gone up so much. Another 6 months, it's definitely gone up way too much. A year goes by, way, way, way too much. 3 years goes by. There's absolutely no way I'm touching real estate now. And then finally they bite the bullet, but they're getting it at 2022 pricing when I told them to do it at 2018 pricing. Now, if you said, well, isn't it too expensive now, Christian? In some areas, yes, but not in every area. I just got a 0.9% based off of Kyle's, and it was about a 5 cap based off of my numbers over here for a client last month. There's always a deal out there. Sometimes you got to look further, and absolutely right now, if you want a really good deal on cash flow, unfortunately, you do have to look outside of the Lower Mainland. So the question is, do you know how to do that on your own? When you take me and my team on, you don't only get me, you get my Rolodex. You get all of my connections across the country or in different areas, and that includes realtors or property managers as well. If that sounds like something you might be interested in, give us an email and then we'll set it up. Kyle, I'm going to shift it back to you over here. I'm going to do one last cheesy quote over here. In the last talk that I gave, stock markets go up and down, very, very volatile. And this is my quote over here. Your investments should not go up and down. They should be conservatively low standard deviation. The only ups and downs I want for you and your family, I'll say for you and your spouse are in bed.
I had a feeling that's where you're going with that one.
Sorry, I had to do the cheese one. Okay, so I'm going to pass it back to you. I think I do a stop share over here.
I can do it. Boom. All right, so I think it's now my screen. Right? Yeah, perfect. Yeah, so ultimately, yeah, that was great, Christian. I think that ultimately the key message here really is just it's important to have planning, and it's important to know that opportunities exist. I hate it when a customer says, oh, I can't buy in Vancouver because the cash flow doesn't make sense here, so I'm not going to buy anything, or my bank turned me down, so I guess I'm just out and I can't do anything. Like there's always a way of doing it, and I love that you're not just a stock guy. It's a matter of being balanced. So that's really good. I want to go through some quick tips to start to wrap this up, and then we're going to go into some questions. I saw a couple of questions in the chat and a few in the Q&A. So make sure that if you have any burning questions for Christian and I. Christian, I know that you're going to hang around for a little bit, and I'll be staying for a while to make sure that everyone's questions are answered. But let's get into some quick tips and wrap things up. So first of all, when you're getting financing, it's all about debt servicing. You have to focus on cash flow property in order to qualify. Properties like that 0.9 that Christian was alluding to sound really, really attractive to me. Makes it a lot easier to qualify. On the flip side, of course, in general, if you're getting really good cash flow, you may be sacrificing a little bit on the appreciation. But when it comes to getting financing, lenders are looking primarily at the cash flow, not necessarily the type of market that it's in when you're dealing with major banks. And so that's something to consider and think about. I highly recommend you take 30-year amortization on all of your debt, even your primary residence, because if you have a lower payment on all of your debts, that means that you're going to qualify for more money. And so it's really important that you make sure you set yourself up on 30-year amortization on all of your debt. And another thing that's very important is eliminating all other high interest debt. And again, a really good example here is if you have a car loan that you owe 25 grand on with a payment of about $550 a month, that payment is the same as you qualifying on the stress test for $100,000 in the mortgage. So the reality is sometimes people come to us and they have a car loan or two or whatnot, and the way to actually set up your portfolio is to actually pay off those car loans and those debts by paying off that $25,000 car loan. Your mortgage borrowing power increases by $100,000. In fact, often the structure, we talked about step number one. We're doing a lot of things in step number one. A lot of time it's getting, redoing the financing and rolling up all of the personal debts into the mortgage, because that's going to result in the lowest possible interest cost and the lowest possible payment. We're also going to stretch that mortgage to 30 years because, again, we're going to get the lowest possible payment. And in addition to that, we're going to get you a line of credit, which gives you access to capital that you can use to invest. And that's why getting a HELOC is always step number one, to get all this wrapped up into one bundle. Also very important, follow the game plan, because if you fail the plan, you plan to fail. So that's my cheesy one. It doesn't have any sexual connotations, unfortunately, but the key is it's important to make sure that you have a game plan and you don't get pulled in a million different directions. I see this all the time where investors are getting into it and they're new, and they start to look at things and they say, oh, that's a really shiny penny. Oh, that's really cool too. Oh, maybe I should just invest here. Or maybe I should do a development deal, or maybe I should buy a condo in this town. It's much better to have a clear vision of where you want to take things. And one of the things that I like to say is a lot of the time my job or our job is to actually close some doors and say, you know what? I know you want to buy $10 million worth of real estate in 2 years. You actually can't, but you can do this. You can apply for $1 million, and based on that, here are the options that you should be looking at, and it helps narrow your focus down, give you laser vision, which will allow you to grow and to actually take steps forward. The other thing that I recommend is surrounding yourself with experts who understand how to invest in real estate. That's why I invited Christian to come and speak today, as he's one of, or the only financial planner that I know that is actually pro real estate, which always surprises me, because you're a financial planner. I feel like real estate should be a part of that financial plan, and yet a lot of financial planners don't really include the real estate as part of that overall plan. So I think that's really important, that if somebody that has a view of both stock investing and also real estate investing. At the same time, too, it's not good to only be investing in real estate. You need to have some liquidity, and then you have nothing to use to pounce if an opportunity comes up. And also, if things happen to specifically the real estate market and you have no liquidity or no assets anywhere else, that could be a real troublesome situation for you, too. I also want to mention, too, that about a year and a half ago, I started up a company called Green Wealth, and that's kind of similar to what Christian does, actually. It's a little bit more geared towards the mortgage planning side of things. But for those of you that really want to take your investing career to the next level, I did start up a company called Green Wealth, and that's a real estate investing consulting company. So we really look at trying to plan things out, and it's an unbiased approach. And so we're really trying to make sure that we link together the accountant and the lawyer and everybody together to make sure that there's a holistic plan involved and created. I find that a lot of the time you talk to one mortgage broker, you talk to an accountant, you talk to a lawyer, and you're more confused than anything, and you don't really know, how do I take the next step? And so I think that's really important, and that's why I started the real estate investing consulting company, to dive deeper into this and really give people advice on how to build a real estate portfolio. There's lots of cool tools and things like that we built inside of it. Again, similar to Christian, we have some spreadsheets that we've built on future portfolio planning, and also doing a deal analysis where you can take a look at your current portfolio and see what the winners and which ones are the dogs and which ones you should sell and which ones you should keep, and restructure your portfolio to maximize your return on investment. So if you want to learn more, you can always book a consultation with us today. You can go to our website and you can learn more about our upcoming webinars, downloadable spreadsheets and FAQs and whatnot. In addition to that, I am a best-selling author, actually two-time best-selling author, because I was a contributor in a book that Ozzy Jurock produced a couple of years ago. But I did write my own book, Rockstar Real Estate Investing, and it's all about the fundamentals of investing in real estate. If you do not have a copy of this book and you'd like to learn more about it, or if you know somebody else, one of your friends or family, I bought a lot of my own books, not because I love myself, but because I got a really good deal. So I'd love to give a book out to anybody who's interested in getting one. You can email info@greenmortgageteam.ca if you'd like a copy of that. And here's our contact information. I must say that we literally just moved last week. That's why you don't see my fancy logos or anything behind me. It's just blank whiteboards. I just moved offices as I bought another mortgage brokerage and closed on that about a week ago. It's actually a company located in Vancouver that funded $1 billion in mortgages last year with 40 agents in it. And so it's a big another step for me in my career. But now I don't have all of my stuff up in my office. I literally started and worked out of this office starting yesterday. So I don't have my office set up yet. So please ignore Pender's address. I'm not on Pender anymore. I'm actually at Granville and 10th in Vancouver. Now I'd like to open it up for questions. I know that there's some questions that that people were putting into the chat and also in the Q&A. So I will start with the Q&A first, and then once we go through those questions, then we can skip out and jump into the chat to see if there's any questions there that weren't answered. So Giovanna has a question. So can you get a Heloc on a rental property which is not your home? And the answer is yes. Lenders can do a home equity line of credit on a rental property. One area that is more challenging, however, is getting a Heloc on a rental property that's in a company name. Those can be more difficult. So that's something to keep in mind. But many lenders will give you a home equity line of credit even on a rental property. So something to keep in mind. Jen has a question. Kyle, it seems like one needs an existing home to leverage a Heloc. How would the strategy change if one is looking to get into the real estate market? Also, I'm not sure I understand the high gains. Is there a mortgage insurance premium with 5% down, mortgage loan interest, property taxes, and strata fees? Could you explain? So Jen, when I was referencing the appreciation gain, that's purely just you're putting 5% down on the property, and how much does the property increase by? Yes, you were referencing some of the other things like the mortgage insurance premium and other costs. Those costs would have been rolled into the total payments that you have on the mortgage. And so one of the big challenges, of course, if you bought a property 5% down, it's probably not going to be cash flow positive because of that property tax and strata fees and the fact that your CMHC insurance premium has been added to your mortgage. So it's very important to realize that one of the strategies for young professionals that don't have a lot of wealth but have a good income is to buy a personal residence for yourself now with 5% down and eventually turn it into a rental and buy another residence with as little as 5% down. The challenge with this method, of course, is that if you got high leverage on the first property, and keep in mind an insured mortgage, so less than 20% down, requires maximum 25-year amortization, which means your payments are even higher. It will stress your debt servicing and your qualifications. So it will make it harder for you to qualify. But no doubt, if you put it into the spreadsheet, you will find that although your cash flow is now negative on that asset, because you put way less cash into it and you still get the same return on your money on the appreciation. Because if the appreciation goes up by 3% on that $500,000 property every year, you still make 15 grand a year. So now it comes down to you making a lot more money in the appreciation side of things than as an overall return on your investment. That makes a really big difference on your total return on investment. So that's where I would use my spreadsheet, or of course Christian has his tools too. But if you played around with it and looked at what if I put it 5% down versus 20% down, cash flow will be worse, but the overall ROI will actually be better. I have an anonymous question. Can we get a replay recording of the webinar? Yes, of course. So all attendees, or all registrants, I should say, do get a copy of the recording emailed to them after the event, 1 or 2 days after, I believe. In addition to that, we always post all of our webinars on our website. And so you can see all of the webinars that we've done. I've done 13 or 14 webinars so far, I believe, started last February. So I guess it'll be 13 now. And we post all of them onto the website. We've done a lot of different topics. And so, make sure that you check them out and see if there's anything that you'd like to watch. Brittany asks, is it much more difficult to get a mortgage if you're using a company to purchase? So in general, yes, it is harder to get financing when you're buying it in a company name. Some lenders, like credit unions, automatically call that a commercial loan or small business loan, which means that rates are higher or fees are higher, et cetera. If you're dealing with major banks, then it often just means that sometimes the rates are a little less competitive, or sometimes they just won't do it. A lot of lenders are trying to push anything that's in a company name over to small business in general. And so it is more difficult and more challenging. And so I just say that in general, keeping in mind that if you're trying to buy in a company name, that it can be more expensive. Not to mention that buying in a holding company is a higher tax rate than most people are personally. A holding company is taxed at about 50.7% tax. And correct me if I'm wrong, Christian, I think it's about 50.7.
Yeah, Right. It might be up by maybe a point, but like 50.8 or 50.7, but you're absolutely right.
Yeah. So it's not cheap. And in general, on the company name part, where I find most clients usually buying a company name is if they already have an operating company and they'd like to invest in real estate and they have a surplus of cash in their operating company, it financially makes a lot more sense to lend the money from the operating company to the holding company, which then buys the assets, because then you're effectively using pre-tax dollars or mostly pre-tax dollars to invest. And even though you pay more on the tax rate on the income of the asset instead of the holding company, you end up paying way less in tax to take your money out. Because if you took 100 grand out of your company, you'd probably pay 40% tax on that after all said and done, and you're left with 60 grand to invest personally. If you did in the corporate structure, you'd pay about 11% tax on that money. You have 89 grand left over, lend that to your holding company, which then buys the assets. And that's a very general way of looking at it. But that's where normally a lot of people will consider doing it in a company name. Javanna has a question. Do you have to get commercial lending to purchase a 5-plex or a 6-plex? There are a very small handful of lenders that will consider on a case-to-case basis 5 or 6 unit properties. I think there's 2 or 3 lenders in Canada that will consider them. So there's a few of them that will consider a 5-plex or a 6-plex as a residential mortgage as opposed to small business or commercial. So there might be some options, but there's not a lot out there. So we do know which lenders are doing it, and it's just a case-by-case situation. So if you do have a deal that comes across your desk, we can see if we can fit it with residential lending. And there's another question. If someone is highly leveraged and ratios are looking tight but have a fair bit of equity, so 50 to 60% loan to value, would be difficult to obtain financing at a lower rate to continue growing their portfolio. What strategies do you recommend? Okay, so if somebody's highly leveraged and the ratio is looking tight, yeah, in general, it is hard to get financing if the ratios are already tight. That being said, there are some net worth programs that some lenders have. And so if the individual is able to qualify, sometimes we'll look at this and say, well, why are the ratios tight? Is it a lack of income? It is harder to fix a lack of income challenge. But if they're incorporated, sometimes there are special programs that we can use, like corporate net income, where we can use a percentage of the corporate income that the company generated. Or if they're self-employed, then we have lenders that will use a higher amount of the income for the debt service ratio calculations. So there are different options with that. In addition, there are net worth programs where we can increase their loan amount that they can qualify for based off of their liquid net worth. Lots of different strategies there, but the reality is, if they don't qualify to do anything, it can be very tough to grow a real estate portfolio. One other option is to foray into commercial lending if possible, because commercial lending is based more on the asset and the income of the asset itself, as opposed to the income of the individual borrower themselves. Jen has a question. How soon can you convert your personal property to a rental property without any penalty, if any? Actually, there are no penalties for that. So when you get your mortgage, you're usually signing something stating that, yes, my intention is for this to be my primary residence. But if you change that later on, there's no penalty to do that. There's no implications whatsoever from the lender's side. There's no mortgage penalties or anything like that. One thing to note, however, is once you change from being your personal residence to a rental property, now any appreciation that occurs on that property from that point onwards is subject to capital gains tax. And so you will be paying capital gains when you do dispose of that asset. And so all of a sudden there's a big tax shift on that. Only other things that would be consideration here is if you bought this and you claimed first-time home buyer programs, like the program where you wouldn't have to pay property transfer tax up to certain prices, and then you don't live in it for the full year, then the government may send you the bill for the property transfer tax cost later. So those are certain situations where if you're using government programs, you do want to read the fine print.
Kyle, can I just add one thing to that?
Yeah, please. Yeah.
It's still not a bad strategy, but one thing to also realize is once you change it to a rental, you also have the tax deductions. Yeah. The interest on the mortgage, property taxes, any renovations that you're doing to it, all of that is deductible. And it's quite nice to get all those deductions out of the way so that you could actually show a rental loss,
Yeah. Yeah, exactly.
Or break even if you try to amortize it out, because you're going to get all of the gain. You're going to enjoy in the tax deductions along the ride, and you get to shift over to your next property over here. So I think that's there are many, many advantages to doing something of that sort.
Totally. Yeah. And I find looking at most people's tax returns, a lot of properties are hovering right around neutral. Not a lot of properties are actually claiming a large surplus of taxable income when you convert those properties, especially if you freshly purchased it not too long ago. You probably got pretty high leverage, 80% leverage or 95% leverage even. That's going to help you because you're going to be able to write off all the interest costs on that mortgage. Ina has a question. I was told today that when applying for a mortgage, some lenders look at the Heloc funds that I'm using, not at the interest rate I'm paying, but at higher interest rates and lower amortization, almost as a mortgage with less favorable terms. Hopefully you can clarify that. I'm in Ontario if that matters. So yes, so a couple of things to factor in. Number one, a lot of lenders, the vast majority of lenders, when you have a home equity line of credit, number one, when you go to qualify to get it, you have to qualify as if you're borrowing the whole amount. Number two, once you have it, a lot of lenders will assume that you're going to borrow the whole amount. So this is a change that happened probably 4 or 5 years ago. But a lot of lenders all of a sudden said, you know what, we want to assume that the borrower may borrow all of the money available to them on their line of credit, and we want to service all of that. So if you have $1 million line of credit on your house, the lenders would want to use and assume that you're going to borrow $1 million, which is kind of crazy. In addition to that, they use a certain calculation. They assume the stress test interest rate of 5.25%, and they also assume a 25-year amortization to calculate the payments. And that means that on $100,000 in a line of credit, they're assuming a payment of approximately, I think that the calculation is $567 a month or something like that. So it's quite steep. There are some lenders that only look at the balance owing on the line of credit, not the limit. And so some of those lenders, you can actually do this. And if you're borrowing the money for the down payment on a rental, then we have to debt service that payment, but you don't have to debt service your entire limit to do that. We've been finding that a lot of our business have been going to the lenders that debt service the balances on lines of credit, not the limits. I think if I look at it, actually, 2 out of the top 3 or top 4 lenders that we dealt with last year are lenders that calculated on the balance, not the limit, and that's most of the lenders actually that use the balance, not the limit overall. Let's see here, a couple of other. I'm just going to check the chat and see if there's other questions. Yeah, Bill was mentioning about the RSPs, and if you take the money out of the RSPs and you have to pay tax on it, and that's something that doesn't get noted. And I agree with that. The flip side, Bill and Christian, I think you probably have some thoughts on this too. But I think in general, the idea behind using the RSPs is that you put money into the RSPs when your income is high, because you're going to get a higher amount off on your taxes. And then when your income drops, then you're pulling it out when your income tax bracket is lower. And so you're basically creating a spread between the amount of tax savings you got when you were a high income earner and putting money into the RSPs and the low tax bracket that you went into retirement when you started pulling the RSPs back out. So I don't know if you have any comments on that, Christian, you wanted to kind of clarify.
And I think, often I'll get people that will ask something in even a forum like this and says, is RSPs a good or a bad thing, right? It's kind of like trying to give medical advice without getting the full picture. Because you want to analyze things such as, do you have pension? Do you not have pension? How old are you and how far are you from it? How comfortable are you with investments? And I add real estate into that mixture over here. The real estate could absolutely bury the RRSPs, even with the taxation that's waiting for you on real estate. So everyone is a little bit different. So to be completely transparent, I myself have RRSPs, but it doesn't make the bulk of my net worth. Real estate by far makes the bulk, but it still has a place. It still has a place in it. I own real estate outside of a corporation. I own real estate inside of a corporation. I'm married. I do have children. And when I retire, I'm going to need a source of income to draw from, but I'm definitely going to pass on the majority of my wealth. Right now, the growing isn't the problem. The taxation is the problem. I can't emphasize that enough. If you guys are on this call right now, you're smart enough to realize that real estate is probably a good thing, which means you'll probably do it if you're not already doing it heavily. If you're already doing it, you're almost considered a bit of a professional investor because you've got stocks, you've got real estate. Your problem isn't going to be growth. Your problem is going to be taxation. Finding strategies to get the money out into your hands in a legal, tax-free way, that is going to be your big challenge of what you should be concentrating on. My uncle is the one who actually turned me on to real estate. By the time he retired, he had 25 properties in the multi millions. He did zero tax strategies. He was an engineer. He did zero tax strategies because he didn't think he'd need it, because at the beginning, he never thought in a million years he would have that many. And the tax bills that he could have avoided by just doing a little bit of planning, never set up a holding company, never set anything out of, all owned personally, and didn't really realize it. And so I think a lot of people could avoid these things. And he never, of course, had an advisor himself. He thought, I'm a smart guy, I could figure this stuff on my own. What he did was he ended up paying significantly more in taxation than he needed to, and he'll be passing on significantly less to his children than he needed to as well. So a quick answer is RSPs plays a part, TFSAs play a part, a holding corp plays a part, but we can't really comment on it until it's been what I like to call diagnosed, right?
Yeah, 100%. Anna had a quick question in the chat, which was going back to the Smith maneuver. Is that tax deduction done on the personal tax, I assume? And yes, Anna, that is correct. So the Smith maneuver is going to reduce your personal taxable income by allowing you to write off the interest portion of the payments on any money you borrowed to invest. Let's see here. There's another question, I think, about, here we go. Tara has a question. Does having kids, your kids in a rental property count as living in the residence? So you can put 5% down. Yes. So technically, if immediate family of yours is living in the property, then you can put as little as 5% down. So if you or immediate family are using the property for personal use, then you can do that as a secondary home, which means that you can put as little as 5% down. So it's 5% on the first 500 grand, 10% on the remainder above that, up to $1 million. So effectively, if you bought a property for $999, your down payment would be 7.5%. Anything of $1 million plus, you cannot get CMHC insurance on, and so the down payment jumps up to 20% down over and above that. Javanna asks, is Kyle's book available for PDF in PDF for download? I believe it is. I'm not sure if it's on my website, but if it's not, if you email us at info@greenmortgageteam.ca, then I believe we have a copy that we can also PDF to you as well. So I think we've answered all of the questions in the chat and the Q&A, unless anybody has any last minute questions that want to shoot over to Christian and I. If that's all the questions, then thanks so much for coming out. I really appreciate seeing all your faces. Hope you guys gathered some new information today that is useful to you. And if you have any questions for either Christian and I, you have our contact information. Feel free to reach out. We're both friendly guys. Neither of us bite. Well, I don't know about Christian. I don't think Christian bites, but I don't know him well enough to know that part. But overall, if you have any questions, we're both open, and we'd be happy to help you in chat.
Yeah, absolutely, absolutely. Best of luck for everyone. You're doing the right thing by educating yourselves.
Yeah. Thanks, guys. Have a good night.